Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul go in depth on why you need bonds. Despite low rates of interest and their limited ability to outpace inflation, bonds are essential in all but the most aggressive of portfolios. By understanding the mechanics of coupons, par value, credit quality, and duration, you can start to understand why bonds are a sensible, low-risk, low-return investment. When stocks tank, there may be a flight to safety, which can drive bonds up. But the biggest benefit of fixed income comes during withdrawals, where bonds can mitigate your sequence of returns risk when it matters most. And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So a couple weeks ago, we were talking about asset allocation and the mixture of stocks and bonds that Trish and I recommend for a portfolio. We talked about kind of within the stock side, growth value, international versus domestic, and that mixture of like 100% stocks to 60%, 40%, 60% stocks, 40% bonds, kind of why we don't want an all bond portfolio, and it definitely loses value to inflation. And even though it's kind of low investment risk, the other risks to account are pretty high. And after our conversation, we realized we didn't go inside the bond part. We did on the stock side, but we forgot to do on the bond side. So today we're going to go inside the bond allocation of a portfolio. So if we're putting together a 60-40 portfolio, because it's a portfolio that has bonds in it, we need that for the protection side, for that downside protection, but we don't want an all bond portfolio. So we're going to imagine our 60-40 portfolio. But now we're going to talk about, depending on client situation and a few other factors, what goes into that 40% bonds. So buckle up your seatbelts, because nothing gets as exciting as bonds. I remember writing a long time ago how no one buys bonds for fun. Everyone always buys stocks for fun. Today, we're discussing bonds just for our own entertainment. So Trishul, why don't you start us off? Bring us into the exciting world of bonds and just what is a bond, and then we'll get into how that provides downside protection and how we actually incorporate that into portfolios.
Happy to, Aaron. So when we did speak about this a few weeks ago, I began with the notion that bonds are like the redheaded stepchild of investing. They don't get much credit. Everybody kind of thinks down upon them. They're not as exciting as the equity space, but what I also wanted to highlight in that conversation, and we'll provide hopefully more depth on this notion in this conversation, is that bonds can be pretty attractive, and it's important to understand what they are because they can be a good tool for investment growth over time. So
okay, you'll have to convince me of that, because I like to think of it as downside protection, and even in our you acknowledge as the redheaded stepchild, we still forgot to talk about them. So go ahead.
And you can imagine
me that bonds can be attractive.
Right. At a high level, let's talk about a business. Businesses typically are funded through two main mechanisms, meaning businesses need money and they like to grow and create more money. And two key funding sources are equity and debt. So debt is basically bonds. Equity is stocks. And the way it kind of works is you have a capital structure for a company that has probably some percentage of each. Now, some companies have tons of debt and a small amount of equity, meaning they're highly levered. And some companies have just all equity and no debt. And you can have kind of anywhere in between. So from a company's perspective, for many companies' perspectives, bonds are critical. And Another perspective is obviously other types of debt instruments like your mortgage. It's very important that you have this ability to have a funding mechanism through borrowing and creating debt to have a mortgage, for example. It's very hard for everybody to come up with all the cash to pay for their home. But if they can create debt to cover a good part of the principal, then the remainder can be covered with their down payment and their monthly payments over time and so on. So companies do the same thing to be able to do what they do. And some companies need a lot of debt because they're very capital intensive. They have high requirements for large infrastructure, large capital tools, machineries, real estate, and so on.
Okay, so I own a widget company and everyone loves my widgets, so I'm trying to make more widgets. So I'm trying to hire more people, and so I need more people. I need probably more space, so a bigger building, and the machine that makes the widgets is a really expensive machine. And so I can fund this. I anticipate having greater revenues by building more widgets, but I need to buy the machine first to be able to build more widgets. So I borrow money via bonds to be able to pay for this widget making machine.
Right. And the way that would kind of work is, yeah, you could raise equity and you could go out to investors and say, hey, just give me some money and over time I'll give you some dividends if these widgets do well. But, what you're doing there is you're giving up ownership of your company and you may not like that. And also you may not need to because there is another funding mechanism. There's bonds. And what you would do there is you would issue bonds. And what you would say is the holders of the bonds, they would give you a ton of money. So you go out and buy your widget machine. And then every month you'd use that widget machine to make widgets and make some money to pay interest to those bondholders. Or typically the interest payments are semi-annually, so like twice a year. But twice a year you would send out those checks to those bondholders. And then over a certain period, meaning the time period for the bond, whether it's 5, 10, 15, 20 years, however long it is, at the end of that time period, you would return all the money, and hopefully you would have enough money to repay that, or you would just issue another big bond instrument and then extend that cycle for the next X amount of years. So that's typically how it works. And basically what you're doing with a bond is you're borrowing a good amount of money if you're the issuer, and you're paying interest, and then you're paying it all back. That's the simple story.
So you're borrowing money now, paying interest, and paying it back from future cash flows. So on the mortgage side, it's you earn a salary. You can't buy the house now in cash, but your salary is consistent, your working career, you can pay off that mortgage from future cash flows.
Right. So a little distinction is typically, so with the mortgage, you have something known as an amortization schedule. So you're paying off the interest and the principal over time so that at the end of the time period, all of the interest is paid off of that you owe, but also all the principal is paid off. So you're kind of at zero at the end. Whereas for many corporate bonds, the notion is you issue it, you take in $1 million, you pay the interest on that $1 million, maybe 5% a year, 2.5% every 6 months for the next 30 years, and then you pay back that $1 million.
Okay, that's good distinction. So that'd be like an interest-only mortgage for 30 years, and then you still owe the entire principal on the mortgage after that 30 years, but no lender actually does that for that kind of term.
Not for individuals, but for corporations, this is common practice. And, just some terminology here. When the bond is issued, it's issued at something known as par value. And a typical par value is just like, let's say $1,000. So they're in chunks of $1,000. And this is also known as the face value. So, let's say it is $1,000 face value for one of these bonds. It's also going to have something known as a stated rate of interest. And this is known as the coupon rate or the nominal rate. And, that this comes from this notion that when you used to get these bonds, then you actually get these coupons for, these payments, and you send the coupon in, and then in 6 months you'll get your money and you send the coupon and so on. But now it's all, of course, all digitized and automated and streamlined. But nevertheless, let's say in our example, 5% interest or 5% nominal rate, the coupon payment would be 2.5% every 6 months.
Yeah, I think you actually took that coupon and like deposited it into your bank account like a check. It was like it had a future date. So you might have 30 coupons on a 15-year bond, and every 6 months you like literally cut off the coupon, walked into your bank, and you deposited it into your bank account like you would a check.
Honestly, I've never seen a coupon. So
Have you ever seen a stock certificate?
I have, because I have one, but
Okay.
not a public company one.
Do you have one of the? Oh, okay. I was like I was wondering if you had like one of those. You buy one stock to frame on the wall, so you can get like one single share. I know. There are companies that'll do that as like a. It's not even as an investment because it costs so much more than the actual stock price itself. But it's like it's like a tchotchke. It's like a swag kind of thing. It's just a thing you can buy to as a almost like a decoration.
Right. No, I've not seen one in real life.
Okay, I've seen a few. They actually like they look pretty good. The stock certificates, but as a financial professional, like it's just a pain to make sure this gets tracked and recorded and gets deposited into the correct account. And so I hope to never see one again because it means that someone had it for a long time and have no idea what the basis is, et cetera, et cetera. So, but yeah, they're interesting, but I hope to never see it again.
Yeah, it's from the elder days.
Yeah, but I have never seen a bond. I've only read about them. So sorry, I digress.
All good. So yeah, back to our example. Let's say you have this 2.5% every 6 months. So literally, you'll get $25 every 6 months for this whole term, and that's the point of the coupon rate. So, but the thing is, this 5% rate that's all fine and dandy. But what happens when interest rates rise and all of a sudden the prevailing rate is 7%? Well, now your bond is only paying 5, so that's not going to look too hot. So what that kind of means is the attractiveness of your bond isn't going to be great. It's going to sell for less than that original $1,000. It's going to sell at a discount. And the simple way to think about it in your mind is, yeah, if interest rates go down, the price of the bond is going to if interest rates go up, the price of your bond is going to go down, because the price of the bond has to go down to make it more attractive for having that lower interest rate, given that you can get a higher interest rate in the market. And that's known as a discount bond. Now, the flip side to that is if the interest rates go down, now all of a sudden your bond is looking pretty good. And prevailing interest rates are 3%, but you're getting a nice and dandy 5%. So if somebody wants to buy your bond from you, they're going to pay more than that $1,000. It's going to sell for a premium. So that's a premium bond. And you can kind of see that now that bonds can sell at a discount and a premium, all the other bonds will get reevaluated based upon the current prevailing interest rate, so that they're all kind of on equal footing if you want to buy one. So if you want to buy one that has a 7% rate, well, it's going to sell for a price so that it's normalized against all the other bonds. So there's kind of no free lunch here, right? And they're all kind of equalized on each other with this kind of invisible hand market force that's going on in the back end. But that's kind of the dynamics that we're thinking about here when we think about bonds.
Yeah, so if you had two companies, or even the same company, just different time frames, they have what used to be a 30-year bond, but 10 years have gone past. So there's 20 years left on that bond. And the same company, so same credit quality, they're going to issue a new 20-year bond. So we have same credit quality, same duration, same time frame. Everything is the same except for the interest rates at the time of issuance. Those should have the same yield to maturity. That's the phrase of kind of a single number that accounts for different interest rates. So the old bond was 5%, and it's still going to be a 5% coupon for the next 20 years. But interest rates are down, so the new bond is a 3% interest rate, 3% coupon. So to make sure that those have the same yield to maturity. So kind of you would collect the same amount as it's kind of like an ROI, a return on investment number over the next 20 years. The old bond is probably selling for something like 110. And we could actually do that math, and I if you talk long enough, I might pull out my financial calculator to figure that out. But this is what the market forces we're talking about. So you can either buy a new bond at 3% coupon for 100, or it's like 100. They always list prices relative to 100 as the discount or premium, but they always trade in thousands. Or you can buy the old bond at a 5% coupon, but you have to pay more for it.
Right. Yeah. So the initial yield that we talked about with the coupon, that's something known as the nominal yield. It's based upon that par value of $1,000. But again, that's not what most people will pay if they're buying it kind of after the fact, once interest rates have moved. In that case, you're going to want to look at the yield to maturity, which factors in the notion that the price has moved. The current value of the price of the bond is different than the face value of the bond. And using that, you can figure out, what is your yield if you were to buy it now based on the prevailing price now.
Okay, so I can actually do this real quick if you want to.
Sure.
So if you had a $1,000 bond at 5%, interest rates drop to 3%. Looks like that new $1,000 bond, the old bond is now worth $1,297. So it's actually almost a 30% increase. But the key is, and kind of the way this makes the yield to maturity the same, is at the end of the 20 years, you only get the $1,000 back. You only get the original par value back. So you put in $1,297, collected 5% per year for the next 20 years, but then you get $1,000 back. And so that's why the yield to maturity will be the same. And it's also like 20 years is still a long time frame. So if you can collect an extra 2% per year over 20 years, that's why it costs almost 30% more now. Because at the end, both of those bonds, both the 5% bond and the 3% bond, will give you back $1,000. So that's part of that math. But that gives you an idea, is that as interest rates go down, the value of the bond goes up, and vice versa. If interest rates go up, the value of your current bond that you already hold goes down. But if you hold on to those bonds, called holding them to maturity, both bonds get the same $1,000 back.
Right. Yeah, that's a good point. And the other thing to think about with yield to maturity, or with bonds in general, is we've mentioned this, but just to put a finer point on it, is a big risk with the bonds is that interest rates will change. And, frankly, if you're holding a bond, the risk is that you don't want the interest rates to go against you. You don't want interest rates to rise because the price of your bonds will go down. And that's what you're kind of concerned about. So there's a few other risks that we'll talk about, but a big one at play is interest rate risk. The fact that interest rates can change and go against you, which could hurt the bonds that you're holding. The other way interest rates also play into this concern is that, okay, now you're getting a coupon every, 6 months, and the yield to maturity actually assumes that you reinvest that coupon at the yield to maturity rate. And you can't actually get that rate always for 30 years. So there's a bit of a assumption in there that may not be fully realistic. And that's something to realize when you're actually having these bonds, because if you don't need the money, if you're not on a fixed income and you're taking that $25 every 6 months to cover your living expenses, but you're reinvesting that money, well, you have to go out and buy a bond at not the price that you paid, but the price or the yield to maturity that's prevailing at that moment in time. And of course, that could be different as time progresses, and that's a risk that we also need to think about as it relates to changing interest rates over the horizon of a bond.
Yeah, and this is also like you need to understand these mechanics because it informs so much of bond history, where a mortgage in the 70s would have 15%, but you had no problem with that because your CDs were paying 12%. And like that's just that interplay between interest rates and bonds, it makes a really big difference. But also inflation was double digits. And so since then we've seen interest rates just keep dropping. And so bond values have kind of kept going up over that same time frame. And that's been a big supporter of bond returns over the last 40 or 50 years. But it's not necessarily like, so we have really good history of potential bond returns, but that does not imply we'll be able to get similar bond returns moving forward. Now, the risk is usually pretty low, depending on credit quality and duration, and we'll get into that, because you always get your $1,000 back at the end, but you need to understand these mechanics of how changing interest rates affect value of bonds to be able to look at historical bonds in a kind of different analysis than you would for historical stocks. All the stocks, because you do a good job of talking about real returns, and so it's the risk of equity in over inflation. It is a similar characteristic for bonds where the interest rates at the time are more likely to correlate with inflation, and that can affect bond prices and bond returns over longer time periods.
Yeah,
So
and yep.
I would say if we now understand how bonds work, when you think of history of bonds, what's something you make sure to keep an eye on?
Well, it's a handful of risks that you need to think about. So, this interest rate risk that we're mentioning here, this is true even for government bonds. A situation where if you purchase treasuries, you think, oh, risk free. No, you still have this type of risk to think about. The type of risk that you may not have to worry so much about is, the solvency risk, the notion that you would get the $1,000 back. However, if interest rates do change, well, then you would kind of be hurting because the value of your bond would drop. Even though you're still kind of guaranteed air quotes, guaranteed that coupon rate for 30 years if you buy a 30-year treasury, there's still the risk that the actual bond itself could not have the price that you like. And another great point that you mentioned, Aaron, is inflation. Yeah, we did talk about the notion that we want to understand what our returns are after adjusting for inflation. And the same thing holds here as it did on the stock side. When you think of bonds, imagine you're that company and you borrowed that $1 million and you got to repay that $1 million in 20 years. Well, wouldn't it be great if inflation was so high that $1 million was worth a can of Coke? Well, you buy a can of Coke and say, here's your money here's your $1 million. So that's great if you're on that side. But if you're the person lending the money and there's a high amount of unanticipated inflation that wasn't originally priced into the bond, by having a rate that would compensate for that, well, then you're not going to get the returns you were anticipating. You could get crushed in a rising interest rate environment by holding bonds.
Yeah, and that's a great point. And that we actually, kind of in that like period in the 70s, especially, you never lost money with the bonds. Like, we'll assume there was no default risk in this case, where you put in money in bonds, you collected coupons, and you cashed in your bond at par. You got your par value, you got your maturity. So there was no investment risk with the bonds, but your purchasing power has gone so much that you realistically lost value. And that's why we have, like, when Trish makes sure to look at the real rates of return, while yeah, your investment didn't go down, you did lose out. But it's hard to kind of see that in real time. Like, it's hard to feel, oh, my $1,000 last year isn't worth the same as my $1,000 next year. And I had a $1,000 bond, I collected 3%, but everything I was spending money on went up 4%. Like, it's hard to feel that difference. And so that's why it does take either a bigger picture or a better analysis to kind of really make apples to apples comparisons. But yeah, so that there are times where bond values have gone down, but it's not that often. I think usually not very much from an investment risk perspective, but it usually is looking at real returns that happens much more often.
Right. So, that this inflation risk that you mentioned, that's known as purchasing power risk. And it's a concern with many bond-like instruments. It's a concern with cash, of course, because if you're earning a very small rate in your checking or savings account, or you're earning nothing, with the cash under the mattress, well, we roughly did the math before, but basically a 2% rate of inflation means after 35 years, that $1 million will only have the purchasing power of $500,000. And there goes half your money, just by kind of doing nothing. But also, with bonds, if you're getting less than that rate of inflation, well, then yes, that investment, that interest that you're earning is not covering the inflation, especially if that inflation is before tax, because you're going to pay tax on that money. Even on the government treasury, you'll still pay your federal tax. And you'll lose a good chunk. And even if you reinvest that good chunk, you still may fall behind inflation. And which means year after year, your account will be going up and up in nominal terms, but be going down slightly more and more in real terms.
Okay, so this is actually a good transition. So one question, I was pretty sure that treasuries are federal income tax free.
So the way I understand it is the municipal bonds are federal tax free.
Oh, I'm sorry. Yep. So go ahead. Continue.
Okay. And they could be state tax free and locality tax free if you live in that state or locality. And then on the flip side, the federal bonds are state tax free and locality tax free. However, you will pay the federal income tax.
Yes. Sorry. Yes, you're correct. There's a Supreme Court decision basically saying that one entity couldn't tax the other's debt. And so the federal government can't tax muni debt, and states or even cities that have a state or have a city income tax, they can't tax the federal debt. Sorry, yes, you're yes, because they are still taxable. Okay, so we've just kind of, I think we've been pretty pessimistic on bonds, but you and I both insist we need to have bonds in the portfolio. So when we had that 60-40 portfolio, first, why do we have bonds in that portfolio? And then our next step will be what goes into that 40%.
Right. So with a bond portfolio, there's a handful of things that you can think about. There's bonds that have a very low reinvestment risk, for example. There's bonds known as zero coupon bonds. And what that basically means is they're not going to pay you a coupon every 6 months. Instead, they will sell at a discount, and then you'll get par value back after X amount of years. So you don't have to worry about those intermediate reinvestment concerns because you're not getting money intermediately. You're just going to pay or lend out a small amount of money now and get back more money, a fixed amount of money at one certain date in the future. So you can actually eliminate that reinvestment risk concern. And you can eliminate the purchasing power risk concern, maybe perhaps, because there are bond securities that adjust for purchasing power loss. TIPS. So these are Treasury inflation protected securities. I don't even know if that's the acronym. I should
Yeah,
probably.
that's it. Yep. Treasury
Okay.
inflation protected securities.
Sure. And the
Anytime
notion,
anytime you see IP on a bond or any like bond type instrument, it's inflation protected.
right. And the notion here is, yeah, if that's a big concern, then yeah, purchasing power risk can be mitigated because the value of the bond, the coupon, will adjust for the changes in inflation. And then even
So
the
real
other,
quick on
yep.
the tips, so again, you don't know what your coupon rate is on tips. It will adjust in the future based on inflation. So when inflation is low, your coupon may actually go down to again match inflation. Might be like equal CPI or CPI plus some small percentage. But if inflation is low, your coupon on your tips could go down. So tips help protect against inflation, but if inflation is low, tips will underperform other bonds. So again, more interest rate risk on bonds.
Right. And the other main risk is credit quality, meaning some bonds will pay you a higher rate because they have less of a credit quality. They have a higher chance of an issue coming up that would make it so that they can't pay you the coupon. And from that perspective, the high level understanding is that the treasuries are the safest ones. The US government is supposed to be risk free in air quotes because they've kind of always paid. And the notion there is if you're, if it's just me and my company, well, I'm not as stable or haven't been around as long, and I'll probably need to give out a higher coupon because I might have a higher chance of not being able to repay. So that's another type of risk that we need to think about. But in the marketplace, again, if you're willing to take on that extra risk, there are opportunities to invest in corporate bonds rather than government bonds. And also, if the other concern we mentioned is taxes, again, if you're concerned about that, there's various opportunities. For example, what we just mentioned with the municipals is they're tax free. And all of these different instruments are out there. And before I get into the specifics, what I want to kind of say is at a high level, there's no free lunch here, meaning you can't all of a sudden pick the right instruments and somehow get a higher after-tax return for taking the same amount of risk, meaning everything's kind of going to be normalized. For example, the tips, you get that inflation hedge, but you're probably going to get a lower interest rate on, just normally. And with the reinvestment risk, with the zeros, well, that might have some other risk. With the corporate bonds, you have a higher yield, but you have a higher chance of not getting paid. With the municipal bonds, you don't have taxes, but they're not going to give you a higher yield as other bonds where you do have to pay taxes on. So, the high level notion is that basically there's no kind of free lunch to pick out the exact kind of bond so that you end up doing better than everybody else. What you're really just doing is trading off one risk for another risk.
Mm-hmm. I think the other thing is, well, it's not. Well, it is quantifiable. There's also duration risk. So interest rate risk is the idea that you buy a bond, you don't know what interest rates will do in the future. Credit quality risk is given all the known financials of a company, what is the risk of default? What is the risk that the company either goes bankrupt or doesn't pay what they said they would owe? And this is kind of going back to bond construction. If a company goes bankrupt, debt holders, so the bonds, are paid out first from corporate assets. So the bonds are safer than stocks. Stockholders and the equity gets paid out last. Okay. But this is a kind of one of those risks. When we look at ratings that that insurance companies will put on them, or that credit agencies or ratings companies will put, there's the inflation risk is just unknown future interest rates. Credit quality is the probability that a company will default. So it's kind of like your credit score. That's probably a good analogy, where if they've defaulted in the past, then they're more likely to default again in the future. If they don't have positive cash flow, if they already have a lot of bonds on their books and they're borrowing more, then maybe they can't pay back all the bonds. So that'll affect the rating. So credit quality is kind of probability of a default. Defaults are usually pretty low, usually on the scale of like 1 to 5%, maybe less, depending on the size of the space you're looking at. But again, if they default and you lose your entire $1,000 investment, that does hurt a lot. But then there's also duration risk, and duration risk is just the idea that if this is a 30-year time frame, we don't know how well that company will do over the next 30 years, or even that municipality. It's more of even the best companies now, there's a chance the more time you have, the possibility of something happening in the future. And so even like Apple is a really secure company, has a lot of cash, great credit rating. So if their 1-year bond probably doesn't have to pay very much, probably like really, really low, like what you might get in your high yield savings account right now, maybe even less than that, because the risk of Apple going bankrupt or defaulting on their bonds in the next year is extremely low. But go 30 years out, a lot of things can happen in 30 years. Like not just regulatory changes or environment changes. It could be tax law changes. It could also be just another company that doesn't exist right now comes up and creates better products and overtakes Apple in their market share. And Apple could go bankrupt in 30 years. That is a possibility. And so when you add in longer time frames, there is just more risk. And then there's also, you start to get into interest rate curves. As the farther you go out, both on either on the treasury side and corporate bond side, they're pricing in the kind of current economic environment plus inflation. Like, okay, yeah, if we're going farther out, we need to expect to get a little bit more return. We need a higher coupon on a longer duration. So everything is the same credit quality, same company, same revenues, same amount that they're borrowing. Everything's the same. The longer bond, even at the same credit quality, will still pay more because there is a little bit more risk than the shorter term bond.
Right. So what I'd probably also highlight is the term duration. It's actually not the same as the length of the bond,
Okay. So
the term of the
go
bond.
Go ahead.
So that 30-year bond that's paying 5% a year for 30 years, the duration is actually far less. And before I get to that specifically, what I want to say is we're talking about this notion of duration because it can be used to infer the bond sensitivity to change in interest rates. That's kind of why we care about this term called duration. And what we're hoping to understand with duration is that if we can understand the sensitivity to interest rates, that's kind of our big concern here with bonds. We mentioned some of the other concerns, but a prevailing concern is the change in interest rates. If we can understand that, then we can come up with measures to mitigate that risk. And before I talk about the measures to mitigate that risk, back to duration now. So we have this notion of duration, and it's actually not the entire term for the bond. It's not the 30 years, it's actually less. And the way to kind of think about duration is it's actually how long it takes in years for an investor to be repaid the bond's price, to kind of get your money back. How long does that take? And you can imagine for a 30-year bond, it's not 30 years because, yes, you'll get that face value back at 30 years, but over that entire time period, you'll also be getting a little bit of money back at a time, a little here, a little in 6 months, and a little in 6 months after that. So if you add up all those little chunks, then you'll get to a point where, you'll get all of your money back, and it would be far sooner than the 30 years. It could be like in 20 years for that 30 year. And it'll change depending on what that coupon rate is. For a higher coupon rate, you'll have a lower duration. And, the opposite. for a zero coupon rate, you have the highest duration because you're not getting any money back until the term ends. So that might be a concern because you didn't have that interest rate, that reinvestment risk concern because you're not reinvesting money, but you still have a pretty big duration risk or interest rate change risk because you're not getting any money back to lower your duration. So a higher coupon would help your interest rate risk because you're getting money back sooner rather than later. But in fact, there's another concept that also can help keep your your interest rate risk under control, and that's this concept known as immunization. So with immunization, the notion here is, yes, you're concerned about interest rate volatility, and the notion here is you can immunize a portfolio, meaning you can neutralize it or attempt to neutralize it by matching the duration of the portfolio or of the bond portfolio that you're holding with the term or your investment horizon, meaning how long until you need this money. Now, what that means is if you need this money in 20 years, you might actually buy that 30-year set of bonds because that average duration is 20 years, meaning now you're immunized from that perspective of matching your time horizons with your durations.
Yeah, I think part of the reason I've never... This makes sense from a corporate planning perspective, but when I think of time horizons for individuals, while it's an important part of the conversation, it's if you're 40 years old and you want to retire at 60, your time horizon, like, it might say 20 years, but realistically, you're still gonna hold on to the bonds to help you generate income longer. And so, like, maybe your time, like, do you just find your time horizon for the, like, when you'll need this money as when you're starting withdrawals or when you pass away? That's
Right.
kind of like, I don't really like using kind of tying the time frame of the bonds to the time frame of the individual, because we're still going to hold a 60-40 portfolio for the 20 years after retirement.
Yeah, there's a bunch of ways to think about that. One is you have to be a little more nuanced. Like, again, it's always not set in stone where somebody says, okay, I need this money in 20 years. I'm going to cash it all out and I'm going to buy this, right? And that's usually not the case.
Well,
and it does get
like corporations do that when they do, like, part of their planning. It's like, okay, I need a 5-year bond because I need to be able to get this money. I'll invest in a 5-year bond because I don't need this part, but in 5 years, that's part of our corporate plan to make this investment. We need the money back in 5 years. So like, I think corporations do that, but individuals don't.
Right. Yeah. So the way I kind of like to think about immunization in my practice is I don't get too fancy about it, but there is this notion that, for example, with a purely passive approach to bonds, you would think about the Lehman Ag. And the Barclays Ag. Lehman Brothers no longer.
Lehman Brothers is one of the examples of a company that in 2000 you think will be around for a long time. Right. Sorry, go on.
So in the finance industry, the S&P of the bond world was the Lehman Aggregate Bond Index, and it's no longer called that because Lehman Brothers went under because of an issue with bonds. Mortgage bonds.
Because okay,
but now it's the Barclays
Ag. Full circle. There we go, Barclays Ag.
But the notion here is it's just a large aggregate collection of bonds across different durations, different maturities, different risks, and so on. It's like the S&P 500 of bonds. So if you're looking for like a passive bond benchmark to be, that might be it. Now,
ticker AGG. There's like 4 to 5, maybe 4 to 6 tickers that I have memorized. That, or at least I've like always had memorized. AGG is like the first one you learn.
Right. Yeah.
Like maybe that and like SPY. I think that's by Spider, but
Yeah,
yep,
you get your
AGP.
60-40 of those two, and you're kind of good to go. That's your bogey. And with that, okay, so with the ag, the concern though is that has a duration that is X, right? And that might not fully align with the duration of a client's investments. So I do actually like to step outside that index to change the duration. For example, if there is a much longer time horizon, I would hold longer duration bonds to account for that. And if there is a shorter time horizon, I would change the average duration of my bond portfolio for my clients to account for that as well. And again, it's not to get too fancy about it, but that's one place where yes, you could get a pretty broad basket of bonds that's kind of similar to the S&P, but there could be a little bit of shifting that you could do to make things a little more aligned with what the client is going for in terms of their needs.
Okay, so that's interesting because as you said that, if they had a longer time frame, my thought process would have been I would have added stocks to the portfolio. To So I want to, can you kind of elaborate on that where you would keep the mixture of stocks and bonds the same, but with a longer time frame you would change the duration within the bond side of the portfolio?
Yeah, happy to. So, the common theme is as you do get older, you might shift from, or you do start having closer needs towards retirement or needing the money sooner. It might make sense to start shifting from equities towards bonds, slowly going from 100-0 to 80-20 to, and so on. However, if somebody is younger, but they don't have that risk appetite to be 100, they're more comfortable with an 80-20, but they have a really long time horizon nevertheless. Well, in situations like that, it might make sense to have a longer duration set of bonds than, for example, the Lehman Ag has.
Okay, that makes sense. So in this case, it's this is how you're incorporating the risk tolerance idea and personal comfort, personal risk tolerance of even though their time frame may be long, they still don't want to be they don't want to have too much in stocks. So this would be a way to try to kind of fit that in between scenario.
Yeah. And, on the flip side, you could have somebody who's risk averse and they're on, like a 30-70. They want 70% bonds. And in that case, even there, if it's a really long time horizon, you're going to be giving up a lot. I would say if your duration is too short. However, if you do have a more immediate need for the capital, if it's 4 to 5 years, well, instead of cash, a 5 duration portfolio bonds might be more sensible than, even the Lehman Ag, which would have a longer duration.
Okay. Okay, so now we have a portfolio. Let's go back to our 60-40. Go ahead and describe, so one, taxable account versus a retirement account. What would your allocation look like?
So on taxable account, the notion there is we think about the individual's tax status to begin. One thing we didn't mention with bonds is they're actually okay. We're mentioning tons of things that are horrible with bonds, but here's I hope we finally get to make a good case. I don't know if we're gonna get it all in on this episode, but one big concern with bonds, frankly, is that they are quite tax inefficient. Meaning you're going to be paying your ordinary tax rates, which are the higher tax rates than your capital gains and dividend rates in most situations. And that's not actually good at all because if bonds are throwing off income, which they are, the coupons in most cases, and you get those coupons, and even if you're reinvesting them, you're going to pay a pretty high rate before you get to do that. And that is a concern. If you're in the highest tax brackets, then if we're keeping bonds in a taxable account in those situations, I would recommend the munis.
And I do the exact same thing. I think if client is, especially here in California, high income tax state, if we're doing a 60-40 portfolio in a taxable investment account, we'll probably do all 40% in California muni bonds, just the tax savings on the California muni bonds, given both high income. So again, any muni bond would be federally income tax free, but being California, if a California resident buys a California muni bond, it is also state tax free. So the income tax benefits on California muni bonds for California residents, especially those in higher income levels and higher tax brackets, that tends to outweigh. I think I'm ready to kind of discuss something positive related to bonds. And this is a good illustration of why we keep bonds in the portfolio, is actually illustrating some of that downside protection component. And actually the last decade or so, last 15 years, have actually been a pretty good example of this, where going through 2007, 2008, while stocks were negative, and kind of got like negative 37, negative 39 for the S&P 500, treasuries and T-bills and T-bonds, like 10-year treasuries, they had double-digit positive returns. And there's other characteristics. It wasn't just interest rates, it wasn't just low. It was kind of people buying into bonds. It's what you'll hear called like a flight to security, where enough people were buying bonds through that period that drove up the returns. And you see this pretty consistently throughout the history of U.S. Treasuries, that for highly rated bonds, especially if they're kind of risk-free, they actually can't have a negative correlation to the stock market. And so in the scenarios where stocks are down, it's a realistic possibility, if not quite expectation, that highly rated bonds will be up. That high quality, especially U.S. Treasuries, will be up. And so that's why we use bonds in a portfolio, in a 60-40 portfolio. Now in 2009, I think 2013, T-bills or T-bonds were negative again, I think on the scale of -9, -11. But your portfolio didn't care because stocks were up 26 and 32%. Your overall portfolio still went up even with the negatives on those bonds. And it's that negative correlation aspect between treasuries and stocks that really helps the asset allocation. That really helps the kind of combining the rebalance, the reversion to the mean, everything we talked about on the stock side. But when stocks are down, if your bonds are up, you benefit from that. You don't participate at a negative 37%. You're actually only going to see on the scale of -20, -25. And then because of rebalancing, when stocks revert to the mean and you have a +26 the negative year and -11 on the bond side, you've already sold your bonds and bought more stocks. And so it's that negative correlation aspect combined with rebalancing that really helps provide a better risk-adjusted return. Like Tricia talked about a couple weeks ago, it's that when you add bonds to your portfolio, the sum of the parts is greater than the individual components. And everything else after that is kind of a how can we be a little bit better, a little more optimized? So like the muni bonds are better in taxable accounts because of the tax benefits. But there are even scenarios I've put together a portfolio for clients where it's 6% stocks, 4% bonds. I'll do 30% in California muni and 10% in treasuries because that downside protection is that much more powerful. So that's kind of, in this case, I think the client is a little more risk averse and they want more of that downside protection. So we're giving up the tax benefits of some of the California munis for more of that downside protection. So does that fit in with like kind of a good explanation of why you use bonds? And then we can go into like, what does it look like in a retirement account?
Yeah, it does. And a lot of people think, lately, I've actually heard this for the past like 5 to 8 years, frankly, that interest rates are so low that, how can bonds have a return that's attractive to anybody who's not blind, right? Or the main concern over, I remember a year or two ago, the rates got so squeezed, negative interest rates in Europe and very, very low, almost zero rates here. And then
Here,
everybody's
I'll read you
thinking,
some numbers real quick. These are the
yep,
T-bond returns by calendar year. 2015, 1.28. 2016, 0.69. 2017, 2.8. 2018, negative 0.02%. Is that the period that you're describing?
right, yeah. Well, okay, so now look at the Lehman Ag returns. So I'll even go back further from like 2008, including the big down
Okay.
period. And I'll skip the decimals. I'll just stick to the first number.
Sure.
But 5, 6, 6, 8, 4, -2. This is the worst and the lowest you're going to see. -2, 6, a half, 3, 4, 0, 9, 8.
Yeah.
And in my mind, for something that has far lower downside risk than equities, but still has a positive return, compared to cash, it kind of blows that away. Compared to checking accounts and CDs and stuff like that, you're in a different league right here. You're actually doing better than inflation for sure, and you're getting a real return over this time period. And the worst case, again, you've had the good, the bad, the ugly since 2008. We are including 2008. We are including the coronavirus. We are including a big bull period where bonds are supposed to do bad. But, worst case in an year by year basis, down 2%. But overall, not too bad, once you kind of go all in. On an annualized basis, for this, it's about 4%.
Yep. So if we use, so again, I think that's the upside of bonds. That's why we use them. I know we've been pessimistic a lot this conversation, but we're doing it specifically because we know stocks will go down, and they'll go down a lot. We don't know when, we don't know how much, we don't know what a lot means, but stocks will have that volatility. Now, we like stocks because they have the best upside over a long time frame, but we use bonds especially if we're taking money out of a portfolio. And this is actually, there's really, really good research on this, that if you're in a withdrawal phase, or even within, say, 3 to 7 years of starting withdrawals, if you're taking out 4% of your portfolio and you happen to take out 4%, you're invested all in stocks, and then the market goes down 40%, you now have 55% of what you started with, 56%. The next year you take out the same, what was 4%. So now, a year later, you have 48. You need 100% rate of return to get back up there. And there's really, really good research that if you're taking withdrawals, managing that volatility so that you can take next year's withdrawal, even if there's a down market, basically you don't have to go back to work because you just retired. That's where bonds come into play. And bonds are protecting. That's why I focus on time frames so much. That if you're greater than 10 years out, yes, we can weather that volatility. We can just wait until it comes back up. But if you are within a few years, if you want to stop working and you need to use your money to support your lifestyle, you don't have the time frame to wait and come back. It goes down. You need the money now. So that's why we need to reduce that volatility. And that's where bonds come into play. Whether it's treasuries, munis, AGG, corporates, they all kind of serve this function that if you can envision a period, like the concrete timeline of when you might need to take money out of this portfolio and do it on a systematized basis from one year to the next, that's why you need bonds in the portfolio.
I think that is a very key point that you're making. Imagine it's 2008 and you have, person A, who has just an all equity portfolio and they happen to be retiring, and somebody who has a 60/40 portfolio, person B. And with person B, you have that 40% that was actually up. And if your withdrawal rate is 4%, well, again, 40 times 10 years, you could get that 4% out of that bond portfolio if you wanted to deplete that and get back to, full equity. Just worst case scenario, at least you have an option like that. Whereas if you're full equity and you're taking out 4% chunks and you're down 50%, that's going to hurt quite a bit pretty quickly after a couple of years. So you have these options with the bond portfolio where with an all equity portfolio, you may not have something zagging while the market's zigging.
Yeah. Okay, so I'm not curious so again, we talked about for taxable accounts, we'll use muni bonds. I might use treasuries. Would you use treasuries in a taxable account?
So the way I kind of do it is I do an asset location strategy where I rank all of my investments, based upon their tax effect. And if things are tax inefficient, I try to throw them into the tax shelters first. And whatever's left over, it could be that there is leftover positions of bonds that still need to be allocated in a taxable account. But I think if the person is in a low tax bracket, then it's actually not that big of an issue. We would still go ahead. I would still go ahead and put in some non-munis in the taxable account.
That's a good point. I have done a few times where a Roth IRA will be all equities. The pre-tax account could even, depending on the size of it and the size of the taxable account, could be all bonds. And then the taxable account will be that figuring out the mix. So again, it depends on how much they have in pre-tax versus taxable versus Roth, what the desired asset allocation is. So we're trying to get that 60/40. If it happens that, let's say, 20% of their investable net worth is Roth, 30% is pre-tax, and 50% is taxable. In my scenario, you could have Roth being all stocks, the pre-tax is all bonds, and then that middle 50 gets kind of split 40-10 between stocks and bonds. And then that taxable account, you'll be using munis for that. So in that kind of scenario, in that kind of asset location, or even for myself in a retirement account, if that was the bulk of their investments, how do you break up the 40% of the bond portfolio in a retirement account where we're not worried about taxes?
Right. So in that case, it would be a collection of short-term bonds, medium-term bonds, long-term bonds. I would also include some mortgage-backed securities. So these are just bonds on mortgages. And again, that's a three-letter word in, from 2008. But there are higher quality MBSs, and if you're diversified enough, it can still provide a sensible return stream and on a total return basis. So I think it is sensible to have some allocation to that. And then there's also international bonds. So other governments and other international corporations have bonds as well. So that's also part of my mix.
That's a good point. I do the same thing. It's going to have some international, some emerging markets debt. Sometimes the emerging markets debt and even the international debt, it could be corporate debt in those emerging economies. So the kind of, if they're growing, it could also be government debt in those emerging economies. You start to get into some either benefits or risks of exchange rates between US dollar and whatever that local currency is. You can hedge against that, so there can be either local currency or US dollar investments in these international investments. But if it's usually a smaller allocation. I use something similar. It's going to be mostly Barclay Ag or some kind of passive bond index on the taxable side. I think treasuries. Do you know how much of Barclays Ag are in treasuries versus corporates? or like I use Treasury. Yeah, it's like
It's
general T-bills, like government-backed bonds.
actually, it's my understanding that Barclays Ag is more investment grade bonds. Um, so from that perspective, I'm not exactly sure, frankly.
I I thought it was something like 2/3. Uh, I will actually look this up because I thought it was like 2/3 government securities, only because that's what most of the bond market was.
Well, I think the Treasury itself is probably 40%.
Let's see. So now we're looking at doing Google searches on podcasts. It's awesome. Yeah. So I'm looking at I pulled up AGG,
Yep.
iShares Core U.S. Aggregate Bond ETF. 37% is United States Treasury. 10% is Fannie Mae. So that's the mortgage-backed securities you're talking about.
Yeah.
6% is Ginnie Mae. More mortgage-backed. 5% is Uniform MBS. So yeah. So there's a, and then I think. So yeah, and then it looks like it's individual corporate bonds is the next allocation. It's probably on the scale of, it might be about 60%.
Yeah. If you include the mortgages, yeah.
Yeah.
That's
So
a
yeah,
good
so
estimate.
it's probably something like roughly a third treasuries, uh, maybe 20 to 30% mortgage-backed securities, and the remainder would be corporates. That feels about right.
Right. Yeah, and at a high level, this is supposed to represent the U.S. bond market weighted by its proportion of bonds across these different instruments.
Yeah, exactly. Okay. So yeah, I think yeah, in retirement accounts, I'll do, again, I tend to defer to a SCI in terms of the actual allocation. But if I am doing it for, say, a client's 401k, sometimes it's like just one or two passive bond holdings, depending on what they have available to. It's a lot of times they don't have an MBS available. But they will have just a aggregate bond index. Um, Yeah, so probably similar allocation. Some emerging. Again, it's mostly going to be that that Barclays Ag, or something like that, which will be, again, 35 to 40% Treasuries, and that'll take up most of it. There are times. So this almost like gets back to like our growth versus value. Am I accidentally speculating? I think there are times in retirement accounts, because I'm not worried about taxes. I guess depending on time frame, depending on risk tolerance, I might do more corporate bonds because those do have slightly higher risk, higher return functions than treasuries. I'm curious, like, one, do you think I'm speculating? And my guess is that anytime I deviate from the passive index, you're saying, yes, I am. But two, do you have thoughts on kind of philosophy of using more corporates in retirement accounts?
Yeah, so I think in that situation, yeah, the former is speculating from one perspective, but it's not necessarily a four-letter word. There's more letters in speculating than that. From one perspective, for example, even myself, I don't have a strict allocation to ag, and I mentioned I do deviate. It comes down to, from my perspective, that duration mapping. So I run an optimization to get durations either higher or lower depending on the circumstance. And what that means is then, yeah, it would have a different duration than what you would get from a purely passive ag portfolio. And the way you can kind of do that is, pretend you have one basket of bonds with a 7-year duration. Sorry, I'm going to do easy math. 10-year duration and another basket of bonds with a 8-year duration. If you take a 50-50 weight, well, now you have a basket that is a 9-year duration. So you can, change things by doing this type of math and doing a little bit of optimization. If you have, 5 or 6 different things, you can find a combination that's sensible. And it's something I do that does deviate from a standard index. But, again, it comes down to the reason behind it. So if you're knowingly taking on, again, I'm taking on a risk. I'm trading off one risk for another. If you're knowingly trading off a certain type of risk for a sensible reason, then I think it makes sense. For example, both of us have said we're trading off the tax risk and the return risk with the municipals and so on. So that there are reasons to deviate, and I think if it's backed by something that makes sense to you, then why not?
That's a great way of phrasing it. That I'm not betting one bond asset class will do better than another bond asset class. I am kind of, depending on client situation, trying to line up the risk tolerance with their the risk tolerance of the portfolio with their personal risk tolerance and time frame and goals. And so there might be times where yes, we want to have bonds in the portfolio, but we're not withdrawing anytime soon or even on the horizon. We're just looking for that downside protection, that we might be okay with a little more risk on the bond side. And other times, if we're trying to get a you know what? This is actually a good example. If we are trying to get a higher yield in the portfolio because we're trying to actually have a higher withdrawal rate, that would be another example where we will deviate from that passive bond strategy, because the client is taking on the risk of, I'm going to start withdrawing 5% instead of 4%. But if portfolios go down, we're acknowledging we have to make adjustments along the way. We'll probably have to reduce the amount that we take out. And so we're taking a little bit more risk on the bond side to support that higher withdrawal rate. We don't necessarily want to add stocks to add that level of risk. That would be an example of a few times I have done a little more risk on the bond side, so a little less treasuries, but still fits within that 60-40 model.
Right. Well, good stuff.
Yeah, this is one of those things, like, I had no idea how long this conversation was going to go. Like, bonds, you can be done in a few minutes, but you can also go really deep and technical. And I want to thank you for correcting my mistakes along the way.
All good, Aaron. I enjoyed the conversation, and there's certainly a lot that goes on in this space that I think doesn't really get too much light. And frankly, as the investment industry goes, it's actually a big part of the investment industry itself. So I think it's a space where a lot of people can do a lot of things beyond just what you hear about. But yeah, great. Good stuff, Aaron. I enjoyed the conversation. And thanks, everybody, for listening. If you're enjoying these conversations, do spread the word.
Thanks. Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.